Hi there, this is Daniel Rowley, CIO at Financial Decisions, and welcome to our market update for July 2023. So the share market has delivered a very strong set of returns over the last 6 months, delivering returns in the global equity market of about 14% over the first 6 months of the calendar year and about 16% over the last 12 months. Here in Australia, returns haven't been quite as exuberant over the first 6 months, rising by about 5%. However, this is put in the context of the fact that Australian shares held up relatively well during the last 6 months of last year, which is when global equities were under quite a significant amount of pressure. The rally in global shares have really been led by the technology sector, the big tech stocks like Microsoft, Alphabet, Amazon, and the like. And that rally has really been driven by a couple of different factors. One is the excitement around the new trend in artificial intelligence technology. Another being the more resilient set of earnings streams that these companies can generate, even through a period of more difficult economic expansion. And finally, the valuation multiples of these companies have actually increased quite a lot, which we'll talk about in the next couple of slides over the first 6 months of this calendar year. Finally, on fixed income investments, we've seen a pretty modest return there, around about 3% over the last 6 months from global bonds. And really the reason behind that is that interest rate expectations continue to kind of move higher, and as they move higher, the returns from these fixed income funds does move lower. So as I was saying on the previous slide, one of the key drivers of returns for share markets over the last 12 months and indeed over the last 6 months has been the valuation expansion. And on the chart here on the left hand side of the screen, you can see those grey bars, which is basically the market increasing the valuation multiple for different regions around the world. So in the case of the US, you can see nearly 15% of the total return has been driven by investors more willing to pay a higher multiple for the same level of earnings. Contrast that with the actual expansion in earnings growth, which is the little green bars. You can see that's been very modest over the last few months. The other couple of factors that have driven positive returns in global shares, like the US, has been the fact that the currency has delivered a little bit of a positive return, as have dividends, which are a pretty small portion of the overall pie. The other comment I'd make just in terms of the valuation levels is that the US share market is trading on a PE of about 19 times at the moment, which sits in the top 1/3 of the historical range. That contrasts with Australian shares, which trade on a PE multiple of about 15 times, which is broadly in line with the 20-year historical average. Of course, one of the biggest headwinds for equity markets in the last part of last year was very high levels of inflation, which really was precipitated by the COVID supply chain challenges that were being faced. And that inflation then morphed its way through to higher food and fuel prices and ultimately into higher labour and rent costs. The good news is that those very high levels of inflation have started to come off. You can see in the US in particular, the flexible inflation measures have come off a significant way. We still have inflation in what's called sticky items, which is basically parts of the economy where prices go up but are slow to come down. That's in areas like wages and rent, for example. And so that still does remain elevated, but the good news is it certainly showed signs of peaking and it's on its way down. The challenge for us here in Australia is that inflation here is still too high, which simply means that rates are going to have to head higher before they plateau and ultimately can go lower if they are needed to during an economic slowdown, which may lie in the next calendar year in front of us. Just a little bit more detail on the inflation and where it's coming from in the economy. As I've already touched on, it's coming from areas like food prices, and you can see that over the last year, areas like bread and meat and dairy have all seen inflation rates over 5%, in some cases over 10%. Rents, as I touched on, are sitting at pretty elevated levels. Across Australia, in Sydney, rents are up around about 5% year on year, in some places more than that. The other two big areas of inflation have been in utilities prices, so electricity and gas prices have shot up very strongly, as many people with their recent updates from their utilities providers would be well aware of. And finally, education prices do indeed remain very, very high after a period of COVID, when those costs were obviously very low, when we didn't have foreign students here to kind of pick up the slack. And just a very quick comment on interest rates and the path for those ahead. Market pricing at the moment is basically for interest rates to go up to about 4.4%, which is just over another one rate rise. So currently cash rates are sitting at 4.1. So the market is certainly expecting at least one more rate rise, potentially two. And we think that's pretty reasonable given where inflation is sitting, and the fact that the RBA wants to make sure that there is no wage price spiral that takes hold from the expectations that inflation is going to stay higher for longer. And so if we do see those interest rates moving higher, that's likely to break that inflation expectation spiral from happening in the first place. Now, one of the silver linings from higher interest rates is, of course, that fixed income investments are paying a much higher level of coupon than they were even 3 months ago. So investments ranging from cash through to term deposits, mortgage-backed securities, investment-grade bonds, high-yield bonds are all paying anywhere of the order of 0.5% more or 1% more than they were just 3 months ago. So as the interest rate cycle matures and cash rates peak, we would expect to see those yields on those investments in fixed income start to kind of taper out, flatten out, and eventually they'll roll over and be lower than they are today at some point. But for the time being, those securities are paying a very attractive level of coupon. Now turning our attention to the earnings outlook for both international and Australian companies over the last 12 months or so. What we can see is that equity prices bottomed around October of last year, whilst earnings only troughed in the case of the US market in February, March of this year, 2023. Since then, you can see that earnings expectations have actually improved off that low, which has certainly helped continue the momentum in terms of the S&P price over the last 3 or 4 months higher. This is in contrast with Australian companies, and you can see that whilst the share market here in Australia did bottom in October of last year, earnings have actually only just troughed. And one of the main reasons for this underperformance, if you like, of the earnings here in corporate Australia is that our earnings here are dominated by banks and mining companies, both of which are highly cyclical and facing different types of pressures going forward. For the banks here in Australia, it's about slowing corporate or credit growth going forward, and for the big mining companies like BHP, it's more about what's happening in China. And China was expected to deliver quite a good and robust set of economic growth outcomes post-COVID reopening, but that certainly hasn't proven to be quite the case over the last few months. But we're still optimistic that China can stimulate their economy and certainly provide a bit of upside risk towards commodity prices over the next 6 to 12 months. But the other factor that is certainly in the favour of Australian share investors is the very high level of dividend yield that we generate here in Australia. It sits above pretty much every other major developed economy in the world, sitting at just under 4.5% on a net basis. And when you include franking credits, it gets even higher than that. So that really is one of the main reasons that we want to hold Australian shares in client portfolios. Now, I just wanted to shift gears for a few minutes and just make a few points on artificial intelligence and the potential that it does hold for both the global economy in terms of output, improved productivity, and some of the examples that we think are going to play a much bigger role in the future. So the first point I just want to make is that AI is expected to increase global output somewhere of the order of $2.5 to $4.5 trillion per annum. once it gets adopted by firms and individuals. The other point I want to make on productivity is that it's expected to become a major positive contributor to productivity over the next 20 years. This is in contrast to productivity trends that we've seen over the last 10 to 15 years, whereby productivity has actually been declining, or the rate of growth of productivity has been declining. And we think it's probably similar to what we experienced globally in the 1980s, when we had semiconductor technology improve to the point where it supported the increased adoption and use of personal computers, which drove quite a step change in productivity over the preceding decades. So this definitely does have that potential. And just putting some meat on the bones of AI in terms of some of the specific applications that AI can play in different sectors. So there's various estimates that expect that around about 100 million people around the world will be using dedicated virtual assistants over the next 3 years or so. So again, it's just a simple way that we can use AI to enhance and supplement our daily lives, to be more productive and in white collar roles primarily, but not limited to that. The other few sectors that I just want to make a few comments on was firstly in education. So the idea there is simply that every child that has access to the internet and a computer will basically have a tutor at call that can answer any questions that they might have. This is a fundamental change in education, and it's going to be challenging, but I think ultimately it's going to be quite a step change for the positive there. In healthcare, AI is expected to basically help discover new drugs and new materials that companies like Roche and Johnson & Johnson will be able to then go and actually commercialize and turn into a real product. So that's certainly an area where we think is going to be interesting to see how that plays out. In the media industry, it's going to be very interesting to see how that kind of shakes out, because it's estimated that around about 30% of all marketing messages will be actually generated by AI systems, so not non-human systems there. And one company that's actually pioneering how that might actually look is a company called Salesforce. They're actually using AI to generate a variety of different content, including personal emails, client responses, as well as marketing, outbound marketing to their clients. In technology, there are many, many examples that AI have to play there. But it's estimated that AI is actually going to be generating software applications itself, somewhere at the order of 15% of all applications being generated by AI. This is whereby basically software is writing software without the intervention of software developers. Some of the other areas are in there is like producing synthetic data. So American Express are using this already to try and prevent fraud, where they haven't actually got a whole lot of real world data. So that's an interesting idea. And companies like Adobe are actually using AI to augment images and videos. So if you're a marketing or a design professional, you can actually use these tools to effectively do a lot of the heavy lifting for you. Key question for investors to kind of ask themselves and answer ultimately is which companies are going to be winners and beneficiaries of the trends in artificial intelligence. And we think there's really a range of different types of companies that meet this criteria. So firstly in hardware, companies like NVIDIA, AMD and ASML are all semiconductor companies providing the hardware that actually underpins the models and drives the models that are used by artificial intelligence systems. Then of course you've got the data center companies that effectively own the real estate footprint, that house the machines that run these models, companies like Equinix and NextDC here in Australia. In other verticals like software, you've got companies like Adobe, Cadence, Synopsys and Salesforce that are all using artificial intelligence in their software packages to some degree. Then you have the big platform companies like Microsoft, Google and Amazon that effectively own the big processing farms, the cloud computing platforms, that are used by these artificial intelligence models. In other areas like industrial automation and robotics, companies like Siemens and Rockwell Automation are actually utilizing artificial intelligence models to various degrees as well to try and provide enhanced service offering to their clients. And of course, network security and IT security is a very big issue and only going to increase in importance going forward. And so there are a range of companies like Palo Alto that provide that type of security solution. So wrapping all of that together, inflation certainly has been a very big issue in the last 12 months. It's starting to come off, which is really pleasing to see, but it is still a bit of an issue, particularly in somewhere like here in Australia on the services side. So that basically means that interest rates are going to have to go a little higher than they're currently actually sitting in Australia. So sitting at 4.1, heading to probably 4.5% over the next couple of months. The silver lining to those higher interest rates, of course, is that fixed income investments like term deposits and bonds are actually paying a more attractive rate of return to investors. So it's certainly a good thing for many investors. And finally, structural growth themes are really, really critical. And artificial intelligence is just one of those themes. Of course, there are many others, cloud computing, IT security, being a few other ones that we like to invest in.